And it's difficult to give an introduction in a very short time. Gary has quite a background. He's a Notre Dame graduate, University of Notre Dame graduate in marketing. Went to work for Leo Burnett, beginning in Chicago, ended up in Southern California. And while there, got involved with his small Microsoft organization and began working marketing of Microsoft. Worked there for several years, many years, in their marketing area and did phenomenal work. He quit Microsoft, got involved in the ground floor of another organization called Visio. Helped grow that company. Turned around and sold that company to Microsoft. This was about the time I got to know Gary. And I can tell you, I started at the University of Notre Dame teaching corporate strategy as a young professor. And I was teaching the classes, and if you've had a strategy class, it's all about strategic planning. And I was out in the field doing strategic planning projects. That was the goal. Out there doing strategic planning, writing business plans, writing strategic plans. For them to get out and work with real companies. And so we did diamonds from in Moscow, and we did Dick Vitale's basketball line. That was a trip. He came to class and kept telling me, these are primetime players, baby, give them an A. And but this is where I met Gary. And what happens is that every semester I'd have a handful of students that would come to me and say, I don't want to do somebody else's business. I don't want to do somebody else's deal. I have an idea. I want to do my own idea. Is it okay to write a business plan on my entrepreneurial venture? And I'd always say, yeah, okay, we can make that work too. We can make, yes, this is corporate strategy, but yes, you can write your entrepreneurial plan. And then Gary found me. And Gary says, you know, Jim, what would happen if I gave you the money every semester? Because these guys need seed funds for ventures. And what would happen if I just gave you some money to give seed funds to these students wanting to start their entrepreneurial ventures? I said, cool. You know, and so he would give me seed funds and take a look at these ventures and those ventures that needed a piece of technology or needed a trip to really get their venture started. And then what would happen is Gary would come at the end of the semester and pitch their ideas to Gary. And I remember at the end of the first semester, I won't soon forget this, Gary says, make no mistake about it, I'm looking for deal flow. I'm looking for deal flow. That happened to be the semester in which one young lady to do designer silk underwear for, we won't get into it. That was her venture. And I had another guy, an engineer, remember that, Gary? And another guy who was an engineer created a mechanical eraser. That was his deal. A mechanical eraser. He thought it was going to change the world. And Gary, I'm embarrassed to even bring these deals up, but he deals that were coming forward at this time. We were real young in entrepreneurship at Notre Dame at the time. And Gary says, I'm looking for deal flow. From that early beginning, really worked with us. And honestly, I consider Gary really the father of entrepreneurship at Notre Dame. The Center for Entrepreneurship at the University of Notre Dame. And it is the Gigot Center for Entrepreneurial Studies at the University of Notre Dame. He funded the center. He started the center. Bottom line, Gary and I have been partners for a very long time in entrepreneurship at Notre Dame. Advisory board continues to be on the advisory board. The first Irish angel, investment angel, of a group of now 350 investors in the Irish Angel Network. Gary knows how to do a deal. He knows how to do a deal. Professor, he taught me how to do a deal and how to look at a deal. The kinds of things to look for in a deal. The real deal. As a result, when when Mike and Glauser and Dave Herman were putting together the series, they came to me and says, have you got somebody that you would have, the first name out of my mouth, Gary Gigot. You've got to hear Gary Gigot. He has done dozens of deals, and some have worked, some haven't. Part of entrepreneurship is risk. I'm delighted to have Gary with you today and discuss entrepreneurship with you, experience, and what he looks for in a deal. And so with that, I'll turn the floor over as you go. Gary?
Thanks, Jim. Introduction. You know, visiting the space, was it Space Device Laboratory today? Through a full tour. I feel like what I'm going to go through here is going to be like reading a comic book, but bear with me. That's quite an impressive tour. If you haven't seen the tour and the things that they're doing, it's a great testimony of science and engineering that's on campus here at Utah State. You're very right. One of the themes I've loved, or one of the definitions of an entrepreneur that I've seen that's always stuck with me is that an entrepreneur, no matter what the venture is, generally is creating something from nothing, something that didn't exist before. And one of the things I think Jim and I have some professional pride in is that's what he and I did with the Entrepreneurial Center at Notre Dame. When we first talking about it in 1997, I think it was, some of the first business plans I forgot to mention, we did our first business plan competition, and I think we had 2 sports card companies, 6 beers, and 5 bars. So that's, we said, well, starting point, boys, but let's see if we can't broaden the scope here a little bit more. But then from then, over the last, it's now, what's it, close to 14 years, 15 years, Notre Dame has really become the Entrepreneurial Center, known all over the campus, and the business school undergrad is number 1 in the country, and it's just been a great thing to see in northern Indiana, which is not a hotbed of tech or commerce, a tremendous facilitation and kind of movement get created. We have over 300 people in our angel network, and a classic example of Jim and I basically creating something from nothing. What I want to do tonight is just kind of talk about, give you some stories of what's going on in my career. I'm not in the formal talk and to talk at all about my Microsoft background. If anybody wants to know little tidbits about Bill Gates and things like that. And 7 years there working with the company, and that was quite a experience. And now it feels like it's almost 2 lifetimes ago, given in the technology space. But what I'm going to talk about tonight is things that I'm really thinking about now as I'm at kind of a later stage of my investing and still doing things very actively. And here's one of the things I'm thinking about a lot is in terms of a current thought I have is, well, what are the reasons for being an entrepreneur? And to me, these are the ones that really stick. The choices you guys have and other people have is to stay in a corporate job or go to work for a large organization or go to work for anything that's already established. And what I've decided actually in my own life is the things I want to do going forward are ones that deliver on these following points. Number 1, the independence. And I actually went and looked up what the definition of independence is, and it is basically not being under the influence of or control or another or others. And when you're in a large corporate structure, particularly in the way the big business works today, that's not the case. So one of the reasons I'm so hot on entrepreneurship going forward is independence. I have a daughter, which I'll talk about later, who's creating a completely independent life, organic farm in Washington. And that's where I really first started seeing this notion. I think the other reasons for being an entrepreneur is if you've got an idea. If you've got, whether it's a franchise idea, being a franchisee, whether it's starting your own company, whatever the idea is, if you have an idea, that is a great reason for being an entrepreneur. Not to say you can't do entrepreneurial things inside of a corporation or in a large organization, and that is very genuine, good entrepreneurial activity, but I'm talking about being a pure entrepreneur and running your own business, because it ties back to the independence point. Sometimes you can become a questionable fit in a large organization. I can tell you right now, on this stage of my career, I cannot work in a large company. I just can't do it anymore. I mean, I lost that skill probably 6-7 years ago, because there's just too many things you have to do, too many committees, things like that, and I'm much more interested in building things, taking the risk of building things on my own. You have to be comfortable with risk if you're going to be an entrepreneur, but if you are, it's a good reason to become because it's a core characteristic you have to be able to wake up in the morning with a bunch of ideas. And when you're building these businesses, it happens a lot. You also have to be cash and or value creation oriented. You've got to really be thinking about how do I create an independent cash flow from a business that I've created, and how do I carry that forward? And then finally, you got to be a self-learner and constantly. If you're that type of a person, those are really good reasons to be an entrepreneur. And I stated this at the beginning because it's sort of within my mind over the last 2 or 3 years. If I've watched what's going on in the economy, and I got asked by Notre Dame magazine to offer up a commentary where the new job is going to come from in the economy. They asked a bunch of people, and I thought about it. I thought a bunch of people I knew, and I said, people need to learn how to be self-reliant. People need to realize that professions and jobs that they've had before will be gone out of the U.S. economy for good. And people that are getting smart are going out and creating themselves and starting new businesses. And I'll talk about some examples like that. So that's kind of my current thought. Here's my quick agenda. I want to touch on my experience, give you a sense of opportunities. I want to address the ever-changing venture capital landscape because I have a lot of exposure, even though I'm not doing much of it these days. Then I want to talk about a couple companies that I'm involved with that have developed a new category and show why that's such a great model for new business. Talk a little bit about exit management and success factors. So it's kind of covering a lot of the things that I've been focused on in the last couple of years. So my experience, I was originally in advertising when I first got out of school with Leo Burnett. Then I worked for a small agency for 8 years, and then moved from Madison, Wisconsin to New York City. That's a whole other story. But with there, on large brands for Ogilvy and Mather, and got asked by Ogilvy to go out and assist their LA office and pitch a small little software company, which was not an interesting advertising account at all. Had a small, only advertised in trade magazines. And our first meeting was with, Bill Gates, Shirley, and the president of the company. And that was my introduction to Microsoft. And we ended up in business over 7 agencies, and I ended up moving from Connecticut to LA and ultimately up to Microsoft. And that's what led to my whole tech career. It was quite an interesting path, but that's where I really got into software. An opportunity to work with some guys that started a leading category business diagramming company called Visio that started, there was about a $7 million company, and then it ultimately grew to over $200 million and became the complete leader in business diagramming in the business space. So Jim said, we sold it back to Microsoft. So that was an interesting. Then I did spend four years with a company called Fraser Technology Venture, and I'll talk about one of the companies in our portfolio. It's a Seattle-based VC firm, and it's an offshoot of a healthcare firm. That was a great experience, the formal venture capital work where you're looking at 100 to 200 companies a year and making a yes decision on 2 or 3, so that was quite an experience. And now I'm primarily doing advising and investing directly from companies, and I'll talk about one of those. So that's my background. Later on, a couple people asked me at dinner how I made certain decisions and things. I'll be more than open to answering any of those questions when we get to the Q&A. So one of the things that I look at right now, where are the opportunities? And I'm going to focus primarily on the space, but I think this is some of the things that I see from my vantage point in Seattle. So Seattle is probably probably the 4th or 5th largest investing area in the country. Southern California, Boston are 1 and 2. Texas and New York are strong in the. We're the 4th or 5th usually. So we see a lot of stuff. We've got great companies there. Microsoft was founded there. Obviously Amazon. We've got great retail companies and Starbucks and Costco. So it is some impressive of entrepreneurship up there. And so what we see right now is some of the best opportunities and some of the key things that are going on for these categories. First of all, in the vertical market, SaaS or space, there's a lot of great opportunity. And SaaS is software as a service. Salesforce.com, the big company called SuccessFactors, a revolutionary human resource arena. I'm going to talk about a company I'm involved with, but that's a really big space. That's all the cloud computing phenomenon where applications are built relatively cost efficiently, run hosted servers, and people pay a monthly license fee. That's a big business. That's an area of opportunity that's got me particularly excited. Angel investing, with partners is something else that I'm looking at personally, particularly with the Seattle Alliance of Angels, my personal activities. But the other things I'm looking at right now is cash flow businesses. I've gotten reignited and excited about basic cash flow businesses. Because a lot of my career has been building these long, 6, 8 year development cycles on these technology companies that have to wait for maturation. Some of them work, as Jim said, a lot don't. And I've started to focus some of my energies on basic cash flow businesses. Monthly P&L driven, and they have very low startup costs. We're right now in the process of starting a coffee shop in Boise, looking at starting 3 Verizon stores. And my daughter has started an organic farm called Fields up in the Skagit Valley, where she has a sheep herd, she's got organic herbs, she's got, rents out a piece of property, and she's completely independent revenue stream for herself on that basis. And as she was doing that, I start to see how more and more people are going to start, moving down that area. So when you think of entrepreneurship, it becomes a very broad spectrum of activities. And then the last thing I'm at is there's still some pretty relatively interesting, high risk but high reward social plays. So there's a company in Seattle I'm looking at right now that is called Blab, and what they have is a relevance engine that improves the targeting of ads on Facebook. If they're right, it'll be a big success, and if they're wrong, everybody will pretty much go out in 12 months. So you don't want to do a lot of that activity, but right now that's one of the other things I'm looking at. So for my own personal activities, I'm looking at a blend of things that get involved in various parts of the whole startup business origination activity. Let me talk a little bit about the venture capital landscape, and this is just something that I think is important to point out as you think about the internet and internet companies. These are some key trends that are occurring. First of all, it's very cost efficient to get an internet company started these days. Very different than early stage software companies. People can do it without any venture capital anymore. And a lot of people are getting to nice exits with only the founders involved. There's a company in Seattle called Picnic that had a nice little photo editing tool. And they built it up, so Microsoft people got interest from Microsoft, Google, and they ultimately sold the company for $50 million and split it among 4 people. And no venture capital, no angel investing, just these 4 people who put their sweat equity into the company. And that's happening a lot across the country. There's also very powerful angel groups that are starting to reemerge in this area, up in Seattle, in the Bay Area. Another key trend these days. But the biggest one is the social media, internet, financial ecosystem that's I'm sure everybody in this room knows Facebook, and probably if you express it all, Facebook's about to go public at a ridiculous valuation. Twitter will go public sometime in the next year probably. The gaming company Zynga has already gone public, and there's been a number of other ones like that, like LinkedIn, and then in Chicago there's the whole Groupon phenomenon. And what's happening there is really unusual, is that usually in those companies, what you had to do is make, the whole company had to be based on the revenue and profitability of the firm. And that's not the case with this next stage of internet companies. It's also very concentrated dollars. The same set of investors are in the same companies and investing in ways they've never done before. I'll show you a slide on that in just a second. There's also, the IPO market used to be the way that companies got liquid. It's not anymore. There are secondary markets before the IPO, like for example, Facebook. There are a whole set of New York-based, San Francisco-based investment funds that are already in Facebook that have a lot of the shares of the employees before the IPO. And that's a phenomenon that, in my experience, I've never seen before. And it's just started with this set of, financial customers or internet companies. So it's made the IPO market sort of an after at this stage, which is unusual. When I was involved with Microsoft and all the original hardware software companies, the IPO was a financial that drove growth, and that's not necessarily the case anymore. And then there's multiple approaches to seed and early stage, and then even more specialized funds. So the whole venture landscape in the last 5 years has changed pretty radically. So let me show you this chart. This one I really find quite interesting. The left-hand side are all the top names you'll recognize. Facebook, Groupon, Twitter, Zynga, LinkedIn, Spotify, and Yelp. Those are some of the top internet deals that have been done over the last set of years. At the top are some of the top firms. It's you got you've got Benchmark Capital, you got Kleiner Perkins, and Andreessen Horowitz, just to name a few. When historically all these companies would have been involved at the early stage of the valuation of these firms, and when you look and see the blocks, you'll see various points in time that they got involved. Let's take a look at Kleiner Perkins, for example. They got into Facebook at a pre-money valuation of $50 million. I mean, that they would never do that. That's venture capital anymore. But they wanted to have Facebook on their roster. And by the way, they're going to double their money because it's going to go out at 100. They got involved in very late when it was already $4 to $5 billion. They got in Zynga. They were early. It was 30 to 40. They were doing a seed investment. And when you looked on each of the sheets here, the way that these top venture capital firms have been investing in these internet companies it's never been seen before. In the old days, they would always be the first round investors, provide all the early stage capital, and they would build the companies. And so it's created a financial marketplace around these internet companies that is really created a phenomenon that's not clear where it's all going yet. So it's an important point to be aware of as you hear about, just to think of competing in any of these spaces. One of the things is the top companies are going to be very acquisition oriented. So they're going to be very interested in new startups. And that phenomenon has already happened. Google, as an example, who's not on this list because they're an established company, they buy a new startup once a month. So that's become a very interesting marketplace for building young companies. But does everything have to be done in Silicon Valley anymore? I found this really interesting article by a guy in Atlanta who basically had the following thought. Social media is a global phenomenon now. He has a really strong social media company down in Atlanta. He says you can find good talent anywhere, and that's why people are growing businesses in Seattle and Chicago and Atlanta. He also says cities are getting it quickly and putting money into innovation parks and research parks to support development. Further, he says you don't have to live in the valley to experience the phenomenon that I just described. And then a lot of people that are following his, what he's in Atlanta, want to be close to Georgia Tech football. So there's still some of those affinities. So Silicon Valley, even though it's the concentration of financial plays going on, it's not where necessarily all the great companies are being built or will be built going forward. So let me take the conversation in a slightly different direction. Some of the success that I've had in the company Visio that Jim mentioned, a company that I'm going to talk about here called Aprimo, has been in building category-defining companies. So this is a company origination and a company investing strategy is one that is proven to be very time-tested and very successful. And what you do is you identify and significant category. In other words, not much competition and a category that's got an addressable market that could really lead to building a very significant business, even a few competitors. So it's new and unaddressed, and it's a weak competitive frame. The second thing when you create a category-defining company is you have to accept the position of being a market leader. And I'm going to show you some examples of companies that I'm involved with right now that we're applying this formula. We've taken on that leadership challenge, and we're really going to get to a great outcome. But you also have to create technology differentiation. You've got to have a point of difference technically that that can last. Now, an example of a company who's done all these things, and I'll finish the last two. Salesforce.com. They took a marketplace that didn't exist before, that sales automation, on a hosted model, and they completely created it from scratch. And the guy that did it came out of Oracle, and the reason he did it is he wanted to compete with Tom Siebel who had a big enterprise app. And that company has gone, and I think it's probably about 8 years, has gone from zero, nothing, to a complete category-leading solution. They own the category of sales automation. There may be 20 or 30 other competitors, but they're by far the number one in market share. And they did it by all of these points. Better solution, and they took over category leadership. They educated the market on what it means to have a hosted Salesforce management solution, and they beat the marketplace. And now, the cap is just terrific. But what also happens is that once you do the things, points 1 through 4, as the market grows, your revenue grows. So when I was involved at Visio, one of the best pieces of advice we got was from one of our investors who had been involved with Intuit and Quicken in the early days. He said, what we did at Quicken was we were the first people to create personal money management software. Microsoft got into the space, tried to compete with us, didn't knock us off, and so we had a dominant share of an emerging category. When that category took off, 2 out of 3 buyers were buying in QuickBooks, and that's what we found at Visio, and what I'm going to show you at a couple other companies. The formula of looking at companies as from a category definition point of view, particularly technology companies, obviously, has been a tested formula. Let me show you 3 quick examples on this. One that's already cashed in terms of a success, one that's scaling, and one that is emerging right now. In 2 of them, and I was involved in the first one as well. Jim mentioned he taught an executive MBA course back at Notre Dame. The business plan for Aprimo was written for Jim's executive MBA course. So, pretty good pedigree. So let me talk about each of these companies and what happened. So what Aprimo is, it's an Indianapolis-based company, not a hotbed of technology necessarily, but a great team down there. A couple Notre Dame guys, got to put the plug in for that. What they did, they realized that marketing was not automated at all, particularly at the enterprise. This was back in 1997. And so their job was to automate the core marketing processes. Secondly, they realized that the allocation of resources need to be optimized. And those 2 things, and they went after the large enterprise market where the big spends were. And they went in with a great application. The 2 founders, one was the CTO, the other one was the CEO, and they lasted through the whole length of the tenure of the company. But what they found about halfway through the development, in Gartner, which is a leading research firm from this area, basically rated them, top in market share against all the key categories. So we knew in the development of this company, they were winning, most of the orders from the top companies. And the company, it had a relatively long run, but in December 2010, it was acquired by Teradata, and the final price was $525 million. It wasn't as big as some of the other outcomes that could have occurred. We, at some point, thought it would have been a bigger success, but still for the investors, it was a 6 or 7 to 1 return over the time of the company. But they did it by becoming the dominant player, in the category. And, what we learned on this one was the following things, is that the pros of it was a cash sale, so we got cash, we actually have our final payment coming in February, so we didn't have any stock to manage, we didn't have any valuations in the prices to deal with. The founding CEO from the first employee all the way to the end, which doesn't happen. Usually it's very difficult for a CEO to found a company, grow the company, scale the company, and sell the company. You usually have a couple other steps along the way. In this case, all the investor classes won. There wasn't one class of investor that was over another, and all the employees got a great return on their options and got contracts into the new company. So it was a terrific outcome from all those vantage points. Some of it were, we didn't get a big digital marketing lift, which is going on now in the sale of this company. And we had metal versus explosive growth along the way. We did get an enterprise valuation versus the SaaS valuation that Salesforce got, so our multiplier wasn't quite as high. And it took a lot of money to build this business. Over $50 million went in over a 6 to 10 year period of time to build this business out. It was a very solid outcome. Started just with an idea that marketing needed automation, and ended up with 10 years later with the sale of data. Another one that's currently in process is a Seattle company, and this company is called Docusign. And this was 6 guys started this in 2002, and they wanted to bring a digital signature technology they had to the world, basically. And this one was a tricky one, and when we evaluated, we knew this was going to be a winning opportunity, but it was not if it was going to happen, but when. And not if, but when propositions and investing in startup companies is dangerous. because we had to do continual product development and market learning over multiple rounds of funding. Ultimately ended up at 65 total capital in the company. So this is a heavily invested company as well. And then we had to build a strong partner model to drive usage and even board representation. So we cracked a deal with the National Association of Realtors, did a big deal with Salesforce. Both of those groups not only took board seats but invested in the company. And in this case, we're on our fourth CEO. The founder got the company to a certain stage, then another person in to drive the organization of the company, then the third person to drive the move to the SaaS platform, and then the last person that's going to basically end up taking it public. So this one was a little more painful along the way, but I think this is going to turn out to be, it's going to own the category. It's got about 60% share now in the digital signature space. It's competing very effectively against Adobe and companies like Microsoft is a great user of it. So I think we're going to have a big, positive outcome on Docusign. As of the fall of 2010, which is the last financing we had, we're operating at about 60% market share. Adobe's bought our number one competitor. We're riding now the wave of market growth, and our current valuation is over $500 million, and we think we actually have around an IPO track for this company. So again, started with 6 guys, a lot of pain along the way. You can only imagine what it's like to go 4 CEO changes, but it's going to turn out to be. And then the last company I want to talk about in this category definition area is a company I'm currently involved with in Seattle, and where some very interesting things are going on. Sesame basically offers web services to the dental and orthodontic markets, relatively unserved. And this one has been bootstrapped for over a decade, and which means fundamentally we had a development team, and we had very little operating capital in the company, and we had the offices around 4 floors, and a group of us went in and put in $3.5 million back in 2008, and slowly but surely rebuilt the company and refocused it. And now we've become the online partner for all websites, search, social media, reminders, and kind of image management for this marketplace. And it's a very splintered, competitive market and relatively underdeveloped. So we've got a big growth curve in front of us in terms of new members we can add, and also in terms of just overall market growth. And what's happened here is, because we're the category leader, there's a lot of people in private equity and other big dental companies are starting to come knocking on our door, which is always the best spot to be in. One of the truisms in selling companies is companies are never sold, which means you want to be in the position where the buyer is pursuing you, you're not putting the company up for sale. And that's what's occurred with Sesame. Our plan from here is we're looking at either growing organically. We have plenty of money in the company, so we don't have to make any changes. We've got a couple big partners that are talking to us, and we're basically listening to a set of different offers that range from private equity partners to help us grow to the next level, to even other outcomes that could occur. So it's been an interesting process with Sesame. It's taken over 4 years to turn it completely around, but it's got the number one application for dentists and orthodontics. It's all SaaS based, and it's in the absolute sweet spot of what big private equity firms are looking to invest in. So again, here, this one is going to turn out positive. Now, I will say that over the time, as Jim mentioned before, these are 3 companies. One that's successful. The second one I know is going to be successful, Docusign, and same with Sesame. But along the way, there are still, many companies that don't work. In basic angel investing, they always say there's a rule of 10. If you have 10 investments in angel investors in companies, basically 1 or 2 are going to work, which are going to give you the return for your whole investment pool, and 4 you're going to lose all your money, and another 3 or 4 you're going to get a moderate return. So this whole area does have the risk associated with it, but there's a lot of things you can do to kind of mitigate that. The key common characteristics, I think, of the companies I just described, and the things I look for these days when I invest and partner with entrepreneurs to build their companies are, I look right away for business model clarity. No matter how good the technology is, I want to understand that the entrepreneur and the team understand what the business model is and can clearly express it. It's always great if it's in the technology space. to have a point of technology difference. You know, there's just no doubt about that. You have to, at the day one, you have to have a capitalization strategy. In other words, know how many rounds of funding you're going to need, how much capital that is, what that means to the dilution of the founding shareholders. All of those things have to be figured out, in my mind, at the beginning, because that then gives you a roadmap. Certainly, circumstances change, facts change, and you have to alter your plans, but it's always best to plan it ahead. You need growth and scaling strategies, either both the growth you drive yourself and the growth that you drive with partners. And that's a critical step. Sometimes you have to take on incremental funding to do that. We might decide with Sesame, for instance, we're going to stay involved in the company the next 3 or 4 years. We're going to bring in a partner to help us scale and drive the company up higher and therefore have a better outcome at the end. And then you always got to be thinking ahead to what's your exit you're planning. Are you running it for cash flow, or are you going to run it, you know, to be sold into somebody else's distribution system, basically? So those are the common, you know, characteristics. The ultimate exit is always the ultimate metric for category defining companies is the exit, and this is, you know, the quality of the exit is determined by the percent of ownership that each of the key shareholders have in the company, both investors and employees. How long it took you to get to the exit is always a key factor. The downside risks along the way, you know, and they occur rapidly and oftentimes very unpredictably. And then how complicated your capitalization table ultimately is. And there's a whole set of alternative outcomes, you know, that occur, you know, with startup businesses. It could turn out to be a great cash flow business. There's a capital efficiency sale, like I mentioned before. You start a company, don't put too much capital in, it comes to a great outcome. And then, you know, companies like Visio, we went all the way to and through an IPO. We got the company public, and then later on sold it to Microsoft. So, you know, there's a lot of lessons learned in terms of how you both create and then build these companies along the way. But at the end of the day, the reasons for success in these category defining companies is the following things. Usually the CEO function and the person that's in it, or the way that job is managed, is handled very well. I will tell you, in the case of Sesame, we actually have an issue right now as we're building the value of that company, where our founder CEO is actually, you know, not involved in the company, and that was another painful move, but we had to do that in order for the company to take off. You have to have a great category. The category you choose to build your business in is really important, and if you have a business and you don't know what category you're in, you have to do some real homework there. As I said before, technology advantage and the ability to create technology differentiation is what creates premium valuations in startup companies. And then, you know, execution. There's the guy that's the CEO of Microsoft right now, big guy by the name of Steve Ballmer, and he used to sit in meetings at the top of his lungs when things got awry, and he just punched his fist and yelled, block and tackle, block and tackle, block and tackle. And that was his way of saying that, you know, execution, strategy is great, but execution and daily operations is really key to making these startup companies work. And then finally, you got to have both the vision for where you're going and the patience for the company to achieve that outcome. And when you do these things, if you have the right characteristics and you do the right, you have these other reasons for success, you could generally end up in a really great situation with an above average return. As I said earlier, I want to make one final comment on cash flow businesses. Is I've been looking at the kinds of companies that, you know, that I showed before, like Aprimo, 10 years from start to finish to its exit. Docusign, by the time it gets to an outcome, will probably be 12 years. In the case of, you know, Sesame, 13 to 14 years. You know, that's a lot of patience for the outcome. I mean, that's a long time. And as I look at today's market, I think there are a lot of really interesting opportunities in smaller cash flow businesses. I think that's an area I'm personally going to start looking at more and more, where you find a particular business niche, you understand what its cost structure is, you understand what the profit, you know, what the potential revenue stream is, and if the gap in between there is large enough to make it really interesting and worthwhile, getting a set of Verizon stores is one thing we're looking at, or small coffee shops, believe it or not, can be profitable, and a whole bunch of other things, whole other business types. And so one of my areas of real interest is studying and working on cash flow businesses, because I think it's one of the greatest ways you can create an independent life by having, you know, a self-sustaining business that basically flows positive cash. It doesn't have to be an IPO or a merger or sale or big outcome. I think it's another area. It's one of the great ways to take great education and training and all the disciplines and apply it. So that's another area I would suggest that folks think about and look at. So why don't I stop my formal comments and just open it up for Q&A from here.
So going back to when you were talking about social media, on an investing standpoint, both, LinkedIn and Zynga, both since their IPOs have happened. I think the same thing's going to happen with Facebook. From a young investor, should we invest in something like that? From your recommendation?
I think that a lot of value has already been claimed in Facebook, and I wouldn't do anything right away. I'd wait till Facebook's sort of a mature stock to see where it ends up. Because at some point, there's got to be a day of reckoning where profit and revenue takes over again, right? One of the interesting things that's going on in the market right now, if my data is right, and I think it's still pretty current, I think if you look at Microsoft right now, I think it's trading at 10 times earnings. Not 30, not 40, not 60 like some of these other companies, 10 times earnings. And they have billions of dollars in earnings, right? So they're getting no premium for their earnings. And if you take Facebook's earnings and multiply it, on that number, or give it 20, right? Give it a premium, give it 20. It's not going to add up to 100 million. So what always happens in the marketplaces is there's always a reckoning where there's a certain view on one day, and the next day it's all profit and revenue again, or it's revenue growth and profitability percent. And when that happens, these internet companies are going to get slammed. It's happened before. We've seen Amazon go from 90 to 3. So anything that's happened before in the stock market is going to happen again. And they told me that when I owned Visio. I said, "It's not going to happen." It happened. So I would let it. Unless you own it now, I'd let it get public and watch it, and it may make sense downstream. So.
It sounds like you know quite a bit about market share. I just understand being on the ground floor is a good way to get market share, but what's a way to protect market share and maybe gain some market share on other companies that are in the market?
That's a big question. So first of all, in gaining market share, I tell you, the guys my experience at Microsoft was unbelievable in terms of people who knew how to gain market share and who tracked it relentlessly. The thing we learned at Microsoft, and we also learned at Visio, is there's no silver bullet. There's not one thing. It's always the execution of a completely comprehensive plan that's relentlessly executed. If Microsoft was good at anything, it was just, getting the winning review, getting the best channel placement, getting, whatever, creating a great product. They did everything, checked every box over and over again, never stopped. With Excel, with Word, with all those products. So in gaining market share, I think that's the way you do it. And in terms of protecting market share, I think has a lot to do with how well you understand every single component of your customer base, why they use you, and how you can keep them. Now, one of the reasons I'm excited about Sesame is we have a 94% renewal rate. So when we get a customer, we got them. So if anybody screws a customer up in the company, it's a really difficult time because 95% of our guys, once we get them, stay with us. So that means all we have to do is focus on the acquisition and keep doing the retention correctly, right? And I'd argue Salesforce is probably the same way. They don't lose very many customers, even though they got a lot of competition. Once people get into Salesforce and get their data loaded, they got them. And so there's a lot of strategies, particularly with internet companies, that you can utilize to keep customers. A lot of it's owning their data. Yeah?
You mentioned monthly cash flow. Why coffee? Why Verizon?
Yes. Actually, in this case, it has to do with the two people that are involved. One is currently running the largest Verizon store in the Northwest in Bellevue, Washington, and is very interested in having their own store. So got all the operating experience. We found a group who can actually work with us on they've got like a sub-agent program. They already are connected to Verizon, and so all we have to do is look at, so got all the operating experience. All we have to do is look at what's it going to cost to get stores well placed, and what's the revenue potential based on 100 stores around the country that are comparable. And that margin of difference is really interesting. So that's why Verizon. The other part about Verizon is people are the activity on phone purchasing and repurchasing is not slowing down, it's accelerating. People buy iPads, and then they got a problem, and it's a really rich space. Not forever. It's probably about a 5 to 7 year opportunity. In the coffee shop case, the person who's worked in a coffee shop for 4 years and simply wants to have her own shop, and found a great location and knows all the data. And again, it's a low operating expense, and we think there's a really nice margin in between. So I finally said, gosh, I think I can do this. P&L, cost. So that's the reason, actually. And we're going to keep looking. There's another one I didn't mention that's a little more problematic, is a company in San Diego that could be a really good actual deal. It's in auto recycling, where you buy crushed cars and basically sell all the parts. And we have both a local business and we sell over eBay. But there, the operational issues have been a little trickier. So with that, I'm very excited about that. If we can build, basically create the right model. So and again, it's a guy who's very interested in it, wrote a great business plan, and we got it up and running. It's just got a few little issues, people stealing our tools and the break-in, and as you might expect in that industry. So, but we think we got most of it smoothed out, and the eBay demand is fantastic. We found a bunch of people from Notre Dame that are at eBay, and they helped us. And so once the parts posted on eBay, they buy them all across the country. They buy carburetors, they buy engines, they buy fenders. It's amazing. So that one could be very good, and that we will run that strictly for cash flow. Yes, sir.
For those of us college students who are aspiring entrepreneurs that are currently very poor at the moment, where would be the first place that you would recommend going to seek funding for a new technology-based business?
I created this phrase, friends and family, which is where a lot of great companies got started. And so that's the starting point. And the next stage, I'll tell you one place you can't go anymore, and it was always a little bit difficult, but going to any commercial bank for any kind of financing, you can't do it. I had a situation recently. I offered to put up X amount of money for a car buying line for this junkyard, so I'd put the money in an account, and I'd completely 100% secure a line of credit, so they could use the car line to buy cars, and as they sold parts, they'd pay it back. So we had a permanent car buying line. The bank wouldn't do it. What do you mean? They wouldn't do it. So that's not a good source of funding. There are still a lot of really great grant programs, small business grant things, but then you don't want to go to angel groups until you've got a really good plan, and you find a couple angels that fall in love with it, and then they kind of carry the ball. But a lot of companies, you look at their capitalization tables, and you'll find the early rounds for friends and family.
Is there a website or anything where you can go to look for these grants?
I don't know if there's one single website, but boy, I guarantee if you type in Google and you do small business financing, or if you go to there's a National Alliance of Angels, that's tremendous. They've got I think it's the National Angels Association. I don't know what the actual name is, but they have an annual conference, and they've got all kinds of stuff on funding sources, specific grant programs, stuff like that. Yes, sir.
Can you talk a little bit about your involvement in social media?
Yeah. Well, so first of all, the concept of social entrepreneurship, I think, we've had this contest at Notre Dame where we'll have social business plans, right? And we only had, I'd say on half of them, where they really hit the sweet spot of it, which is you build a business for, a sustaining business that has one of its core goals a very strong and specifically stated give back program, right? What happens too often is they shift all the way into nonprofit and they forget about creating a sustaining business. So, there's a company I'm involved with right now called See Your Impact that I mentioned to somebody before. And it's a website that's designed to drive micro-giving. And it's a true social entrepreneurship effort because it's going to be run for profit and charge for, kind of handling fees for gifts. only to create enough infrastructure so they can really build a website out. So and they have to pay employees and things like that, but there's no distributed profits or anything else. So those types of things. So I think the first thing on social entrepreneurship is making sure the design of whatever the venture is truly a it's truly self-sustaining, self-funding. And those are fewer and far between. But, I've been involved in a couple different things that way. I always look for opportunities like that, but I've seen too many that are basically, they end up being nonprofits. And it's okay to be a nonprofit, but that's not social entrepreneurship, where they're charitable gifts. There's no investment in a company that sustains. And I've seen a couple people in Seattle do that. They don't end up real pretty. So the social entrepreneurship definition has to be really tight. This guy that's going to come in a couple of weeks, Dave Murphy, started a company called Better World Books, and it had a strong social entrepreneurship theme, but it's a self-sustaining business. It's profitable, and it's got great technology and a lot of other things, but that's the reason it worked. Yes?
You mentioned your daughter with
Yes.
the farm. Did she choose to do that for more of a quality of life rather than, are her earnings great?
Well, that's a really good question. So she went to Middlebury out east, got into Notre Dame, and said, "Dad, I'm not going." So she went to Middlebury because we're always, she's more of a kind of a New England gal, and she studied biology. And I think in her junior year, she sent me a birthday card and about P.S. I think I want to be a farmer. I still have the card at home. So she gets out of school and she ended up getting her master's at Washington State. And ended up going all the way getting her full PhD at the research outside of Seattle in horticulture. So she had that, and then she knew she wanted to buy a farm, and she knew she wanted to grow organic crops. And so what she did is she's got it all kind of integrated. So the research center is probably 3 miles from where her farm is. The farm's only 5 acres, but for the organic herbs she wants to do, it's plenty of product, and all these other things. She's intentionally been following a kind of a mission. So she does like arts and crafts events using the barn on the property. She's got a cottage she rents on Airbnb. She does grant work with the people she got the PhD with, and she's also in a contract for 2 days a week with a new school that's opening up there. So she's kind of layered everything, and she plays music with her, for pocket money with her boyfriend. So she wants a life of complete independence. That is what she wants, and she actually built it very, very deliberately. And it's produce.com is her website, and she's got a blog. And I think she's going to actually at some point she may create a winning brand of organic herbs or something, because she knows the top organic farmer up in the area that supplies all the Whole Foods in the Northwest, and she's worked in the fields, and she's gotten her clothes dirty doing it, and so she's building it from the ground up, and it's really fun. Yeah.
So I've got myself and a bunch of friends. I think we pull out those boxes on the profile of an entrepreneur, the slide that you put up, and we're real interested in kind of the smaller cash flow businesses. And we're optimistic young guys thinking we can kind of go out there and buy bootstraps and make this stuff work. But we go back and forth with, well, should we go work for specific companies and kind of gain that experience first versus just we got notebooks full of ideas hanging around, should we just go? Could you talk about, in your experience, pros and cons of guys just starting out off on the business ideas versus going out and working for a few years in related fields?
Yeah, so I'd comment on 3 things you said. One is, I think if you have a group of people or partners to collaborate with on your venture that you can trust and you want to be in business with, that's a real gift, because that's not always the case. And I can tell in my experience, it's been, I had some great relationships at Microsoft. Some of the Visio was terrific. Some of the other companies, it's not been as jolly, let's say. So that's number one. Number 2, I would say, if each of you guys know for the next couple of years something you want to do, let's say one person's going to go into an accounting firm and somebody else is going to, whatever their occupations are, right? You might want to do that as your primary, business experience, but create a formalized way that you develop a business plan along the side, right? And then if that really starts gaining momentum and you find the right idea, then you can create almost a staggered way where guys quit one at a time so the company can afford it. And so you create a whole process to actually get to your goal. And that's, unless you have something that you know is so right now, getting that initial business experience, particularly if it's relevant to what you're ultimately going to do, is really valuable. It's hard to jump right out of school into an idea. It's hard. And you know, the guys that have done it that we all read about, I mean, these guys are geniuses, and so, you know, that's not me, I know. So I mean, it's but because you need some time to really think it all through until you find that right thing. Once you got it, then you know it's what you should do. So, yes, sir.
When you encounter a concept or an idea, do you consider the way you decide which ones to buy into? Is it somewhat intuitive, or do you have a metric, or do you wait until you see a business plan? How do you decide which things you want to support?
I think it's definitely not intuitive. It's more of, what you try to do is relate, when you look at a business, you try to relate it to a past example of something that worked, and that sometimes works, but in general, it's a lot of analysis, and sometimes it'll all come together quickly, and you got the right thing, and other times it doesn't. But
part of the reason I'm asking the question is any new idea that's likely to really be big is going to represent some kind of discontinuity.
Right.
The experts are probably going to reject it, in my experience.
Yep.
And so basically, to some extent, your actual experience, depending on what it is, might not be as relevant as you would think. I've seen a lot of experts miss a whole lot of big boats.
Yep. Well, Visio is a great example. There wasn't any business diagramming software before it got launched, so you couldn't do research among people of saying, would you buy this, right? So they had to build it and introduce it because they were creating a brand new category. And the three guys that did it came out of all this. They were spot on, big success. Two of the three, after Visio, went and started a second company called Trumba, which is going to be like calendaring for the family, and it was, they went through the same thought process, same guys, and just completely wild pitch. And they kept it alive for 2 years, and it just never went anywhere. So, part of it is, so there's not a magic formula. The one thing that's interesting is the venture investors have done this for a long time will say, no matter how much due diligence you do and how much thinking you do, you go to your first board meeting, and within 10 minutes, there's a big whoops, a piece of data that you didn't hear, something that you weren't aware of. I mean, and sometimes it can alter the whole course. So it's intuition, and it's a science, and sometimes companies you invest in one thing and the thing ultimately works, it two spins over. I mean, those aren't pretty experiences, but that's sometimes what happens. So I don't know that there's any. It's a lot of experience, and it's a lot of background and a lot of analysis.
I would add one more thing to that. In the Irish Angel Network, a lot of the angels say, "What would Gary do?" They do.
Well, just make sure they choose the things that work, not the ones that didn't.
Well, you got somebody that is a good judge and knows how to look at those things and has the right intuition. They look to lead investors. They really do.
Yeah, but that can be. I've followed lead investors right into a sinkhole.
That's true.
And you look back on it and you go, why did I think that guy knew what he was doing on that one? Okay, yes, sir.
What kind of percentage, or I guess, for angel investors or venture capitalists to get involved in an idea, for you to get involved in an idea, what kind of control or percentage or return are you looking for? Or does it depend on the company?
No, each firm, and angel investors are the same way. I think angel investors are a little more risk-oriented. They know they got to have a couple big wins to make it all work. But the numbers for angel investors is what I mentioned before. So they're going to lose all their money on 4 deals, get it back on 4 more and 2 big winners. And they like to, that can get you 3 or 4x return on a total portfolio in total dollars. So if you put $200,000 work, you can get $800,000 back. Now, some of these could end up being off the charts. There was just a company in Seattle called Clarisonic. It was a second-time entrepreneur who had a big success before. It was all funded by local business people. None of the venture capital firms in town got into it. And he put a bunch of his own money in, and they sold for $500 million in 5 years. Now that return was, that'll make that whole angel group healthy for 10 years. I mean, so it is a little bit about the highs and lows. Well, thank you very much. I appreciate this.
Thank you.